At the commercial real estate market and assume it is an exclusive sector reserved strictly for the ultra-wealthy and institutional giants. But the landscape shifted after the 2021 market peak, which was followed by a series of significant price corrections. High market uncertainty forced a lot of big, over-leveraged buyers out, causing institutional volume to drop steeply as they prioritized their existing debt over new acquisitions. This retreat by the big players removes the primary source of aggressive bidding wars, allowing smaller investors to negotiate on properties that were recently priced out of reach. Forecast data from CBRE suggests this period of low competition is meeting a major market rebound heading into 2026. This chart shows that investment activity is projected to jump 16%, pushing the total to $562 billion, nearly matching pre-pandemic levels. This 2026 window offers a rare combination, a rapidly recovering $562 billion market that is currently missing the dominant institutional giants that usually control it. Bypassing the massive capital requirements of a direct purchase starts with pooled capital. REITs and modern crowdfunding platforms allow individuals to buy into commercial portfolios with as little as $10 to $500. REITs operate under a specific legal mandate. They must pay out at least 90% of their taxable profits to their investors as dividends. These platforms allow real estate to function as a passive financial instrument, removing the need for investors to manage physical tenants or property maintenance. Syndications offer a mid-level step for those with more capital who still want to avoid daily management. In this structure, a professional operator assumes all the logistical labor, from finding the deal to managing the property day to day. You enter the deal as a limited partner, typically providing a capital contribution of $10,000 to $25,000. This allows an investor to leverage professional expertise and scale a portfolio without taking on the operational risks of a sole owner. For those pursuing direct physical ownership, the strategy involves looking past high-rise office buildings towards smaller, functional assets. Small-scale warehouses are highly viable commercial assets with simple management requirements. Local service businesses like barbershops represent standard commercial properties often found in local neighborhoods. Small medical offices provide another stable entry point, often featuring long-term, reliable tenants. Maximizing these physical investments means targeting booming secondary markets rather than oversaturated megacities. Columbus, Ohio is currently a prime example of a market with high growth and accessible commercial prices. San Antonio, Texas also demonstrates the high population and job growth typical of an ideal target market. By focusing on these smaller assets in high-growth geographies, physical commercial property can be acquired at price points similar to residential housing. Commercial real estate is accessible today through a series of specific entry points that scale with an investor's available capital. Pooled platforms, syndications, and micro-assets provide three ways to claim a stake in the market today. The economic correction has left a temporary opening for retail investors, while institutional competition remains low. Taking advantage of this window requires moving past the assumption that the market is closed and beginning the process of financial education. Which of these commercial property types fits your current financial goals?